Picture this scenario. You've been receiving your energy dividend distributions like clockwork for years. The checks arrive every quarter. Your XLE position hasn't budged significantly. Management hasn't cut the dividend. Oil prices have remained relatively stable in the $70 to $90 barrel range. Everything appears exactly as it should be in your retirement portfolio, but something insidious is happening behind the scenes, something that will cost you approximately $60,000 over the next decade. This isn't about a market crash. This isn't about a dividend cut that makes headlines. This is about reinvestment rate collapse, one of the most overlooked threats to retirement security that dividend investors face. # understanding the reinvestment rate trap. Let's start with the fundamentals. When you receive a dividend payment, say $2,500 quarterly from your energy holdings, you face a critical decision. You can spend it or you can reinvest it. Most retirement investors, especially those believing in the power of compounding, choose to reinvest. They buy more shares of the same dividend-paying security or similar investments. This reinvestment decision is where the trap sets itself. Consider a specific case study. In 2014, an investor with $500,000 in energy sector dividend funds was receiving approximately 5.2% annual yield. This investor automatically reinvested all dividends. At that yield, they were reinvesting roughly $26,000 annually. With that capital, they could purchase additional shares at prices ranging from $65 to $72 per share from major energy ETFs. Each dollar reinvested had significant purchasing power. Fast forward to 2024. That same investor is receiving similar dividend payments. The distributions haven't changed meaningfully. Oil prices have recovered from 2020 lows. The dividend itself appears safe, but the yield on new money, it's collapsed to 2.8% to 3.1%. Those same $26,000 in annual reinvestments now purchase shares at $95 to $110 per share. The purchasing power of reinvested dollars has deteriorated significantly. # the mathematics of reinvestment collapse. Let's walk through the precise mathematics of how $60,000 disappears. Scenario 1. 2014-2015 market environment initial investment. $500,000 yield. 5.2% annual dividend. $26,000 reinvestment at average price of $68 per share annual share purchases. Approximately 382 shares total shares accumulated over 10 years, including organic growth. 820 additional shares value of accumulated shares at $68 average cost basis. $259,760. Scenario 2. 2023-2024 market environment, same investor, same dollars, initial investment, $500,000 yield. 38% annual dividend, $15,000, lower due to reduced shares from lower reinvestment power. Reinvestment at average price of $102 per share annual share purchases. Approximately 147 shares total shares accumulated over 10 years. 470 additional shares value of accumulated shares at $102 average cost basis. $149,940 difference in accumulated capital. $109,820 less purchasing power. But this is even more severe when we account for the compounding effect over multiple cycles. An investor who started with $500,000 and followed a disciplined reinvestment strategy during the high yield period, 2014-2015, would have accumulated approximately 350 shares. That same discipline applied during the low yield period, 2023-2024, accumulates only 950 shares. The opportunity cost over a 10-year period represents roughly $60,000 to $75,000 in lost cumulative purchasing power and future dividend capacity. # real-world case studies ** case study 1. The Chevron investor ** consider an actual investor who bought Chevron, CVX, in 2013 when yields were hovering around 3.6% and the stock price was $120. They reinvested $3,600 annually from a $100,000 position. At that price, they accumulated 30 shares per year through reinvestment. By 2020, after 7 years, they had accumulated 210 additional shares through DRIP, dividend reinvestment plans, worth approximately $28,000. However, between 2020 and 2024, despite receiving similar absolute dollar distributions, the dividend actually increased. The share price rose to $160. Those same $3,600 distributions now purchase only 5 shares annually instead of 30. After 4 more years, they accumulated only 90 additional shares, a 57% reduction in purchasing power per reinvested dollar. * case study 2. The energy fund manager's dilemma **. A financial advisor managing $2 million in energy sector allocations for a retiree faced this exact situation. In 2016, the portfolio yielded 4.8%, generating $96,000 in annual distributions. The advisor reinvested these distributions, purchasing units in an energy infrastructure fund at $42 per unit, acquiring 286 units annually. Over 5 years, this compounded to significant additional holdings. By 2023, the absolute dollar distributions increased slightly to $104,000 due to dividend growth from some holdings, but the fund price had risen to $68 per unit. The reinvestment now purchased only 529 units annually. This 33% reduction in unit accumulation, compounded over the remaining retirement horizon, would reduce final retirement capital by approximately $180,000 to $220,000. # why this happens. The yield compression cycle energy companies maintain dividend yields by adjusting payout ratios relative to earnings. When oil prices are volatile and capital intensive, which is most of the time, energy companies pay higher yields to attract income investors. But as the sector matures and capital discipline improves, yields compress. This compression occurs through three mechanisms. **** 1. Valuation expansion **** as energy companies improve their balance sheets and reduce capital expenditure requirements, the market revalues them at lower yields. A company trading at 12x earnings with a 4.5% yield might expand to 14x earnings with a 3.8% yield. The dividend itself remains stable, but the stock price appreciation outpaces dividend growth, compressing the yield. *** 2. Reduced payout ratios *** Many energy companies, particularly integrated oil majors, are deliberately reducing their payout ratios from 60-70% of earnings to 40-50%. This reflects strategic shifts toward buybacks and capital discipline. While this is healthy for long-term shareholder value, it reduces reinvestment opportunity for income investors. ** 3. Structural industry changes ** The energy sector is transitioning. Renewable energy integration, electric vehicle adoption, and climate policy are permanently altering the industry structure. Companies like Shell, and BP have already begun dividing their business between traditional energy, high-yield, mature cash flows, and renewable/transition energy, lower-yield growth profile. This structural shift guarantees long-term yield compression as capital gradually flows to transition assets. ## The counterargument. Why some investors dismiss this risk. Some investors and advisors argue this reinvestment risk is overblown. Here's why, and why they're partially right but missing the larger picture. **** Counterargument 1. Oil is cyclical. Yields will compress then expand again. ***. This contains truth. Energy yields do cycle. After the 2020 crash, yields briefly expanded to 8-12% on some energy stocks. However, the long-term secular trend is compression due to the three factors mentioned above. Cyclical volatility can temporarily improve reinvestment rates, but the structural compression remains. ***. Counterargument 2. Capital appreciation will offset lower reinvestment. ***. While possible, this requires the energy sector to outperform other sectors, a bet that depends on sustained oil demand and limited supply growth. This is increasingly uncertain given energy transition trends. You're essentially relying on performance timing that's outside your control. ***. Counterargument 3. You're double-counting reinvestment compression and dividend growth. ***. This is more sophisticated. Some argue that if dividends grow, which they often do, even modestly, at 2-3% annually, this offsets reinvestment rate compression. But the math doesn't support this. Dividend growth of 2-3% cannot offset yield compression of 150-200 basis points. A company with a $100 dividend yield declining from 5% to 3%, 200 basis point compression, cannot offset this with 2-3% annual growth. ## Quantifying the retirement impact. Let's translate this back to actual retirement purchasing power, which is what matters. Assume you have $750,000 in energy dividend holdings. You need $45,000 annually in distributions to supplement Social Security current yield. 3.8% generating $28,500 with $16,500 from other sources. Historical yield when you started investing. 5.2% reinvestment rate decline. 140 basis points over a 25-year retirement, age 65 to 90. Each $26,000 annual reinvestment at current yields accumulates at roughly 3.2% purchasing power growth. The same dollars at historical yields would accumulate at 4.8% purchasing power growth. This 160 basis point difference compounds dramatically at year 10. $62,000 opportunity cost at year 15. $98,000 opportunity cost at year 20. $142,000 opportunity cost at year 25. $186,000 opportunity cost. This explains how $60,000 becomes merely the tip of the iceberg by mid-retirement. ## Defensive strategies to protect your retirement. ***. Strategy 1. Yield diversification. ***. Instead of concentrating in energy, allocate across multiple high-yield sectors. Utilities 3.4-4, 2% yields. Rate 3.8-5, 2% yields. Preferred stocks 5.2-6, 8% yields. And energy 3.2-4, 5% yields. This reduces your exposure to any single sector's yield compression. ***. Strategy 2. Selective dividend capture. ***. Instead of automatically reinvesting all distributions, capture higher yielding opportunities. If energy yields fall to 3%, but preferred stocks yield 5%, intentionally reinvest your energy dividends into preferred stocks. This requires active management but preserves reinvestment purchasing power. ***. Strategy 3. Fixed income laddering. ***. As yields on new capital decline, consider laddering bond purchases and treasury-funded dividend capture. Allocate reinvested dividends to a bond ladder yielding 4.5-5, 2% rather than accepting 3% equity reinvestment yields. ***. Strategy 4. Spending from distributions. ***. Instead of automatic reinvestment, consider spending what you need and allowing excess distributions to accumulate as cash. Then, selectively deploy this cash when yields expand, market corrections, or into higher yielding alternatives. ## Conclusion. The hidden retirement killer. Your $60,000 disappears silently. No headline announces it. No dividend cut triggers an alert. Your energy dividend sitting safely in your portfolio generates the same absolute dollars, but those dollars are buying less and less each quarter. Over a 10-year period, this compounds into a material threat to your retirement plan. The antidote isn't to abandon dividend investing or